Hello my fellow freedom builders and welcome back to the channel. Now, as you might have heard the last couple of days, I have announced that since I'm reaching the 5,000 subscribers on my YouTube channel soon, I will be giving away some of my silver coins, 1 ounce silver Krugerrands. And the only thing you would have to do is to comment in the comment section below, and it would be nice if you would consider subscribing and liking the video as well. But the comments are the most important. And what I urged you to do was to not just write something nonsense in the comments, but actually give me some suggestions or write what you thought about the videos. And one of the suggestions I've heard many times over the last couple of days is, could we get some more dividend payers, some analysis? It is a while since I've looked at that. And yes, of course you can. Your wish is my demand. So today we'll have a look at 3 different dividend payers. Now, they're not the most well known in the market, but I will leave it to you to dig some deeper and do some more research. But what I am going to do is I'm going to look at the charts. I'm going to look at Stockopedia, where I make my quick assessment, and I'm going to look at FastGraph to see if there is some good value, some good potential upwards. So this is not some short-term swing traders stocks. This is mostly long-term dividend plays where you can also write some covered calls on if you are into the options strategies to squeeze some more dividend, you could say, out of the stock. So let's have a look at them. Now, the first one is a company called Manulife, and it is a Canadian-based company, but they are pretty much all over the world, growing very quickly in Asia as far as I can tell. And what they do is that they have an insurance leg, some group benefits and group retirement activities. They have a lot of investments and wealth management. Actually, the wealth management is about 2/3 of their entire revenue stream. So they have some banking and they are making a lot of acquisitions. So that, of course, can be seen on their debt, etc. But it is basically a insurance and wealth management company. I'll not go very much into further details here. I'll link to all the websites here from the companies I mentioned, and you can dive deeper for yourself. Right now, let's have a look at the chart. And the chart here is not really what I normally look for. And some of you might say, aren't you breaking your rules here? And yes, the normal rules I am breaking, because what I normally say is, I want to see a good, steady, long-term uptrend, and to be in a green zone, I want the RSI on a weekly chart to be above 50, and I want the CRS, the comparative relative strength, I want that to be above both its moving averages here. And as you can see, we are comparing with the SPY, the ETF that mirrors the S&P 500. But what we are looking for here is companies that are doing well on the weekly chart. They might not have been doing well for an extended period of time, but they need to show some sort of strength towards the market and be above the 20 SMA here. And if I would make this a normal momentum investment in stocks, well, then I would wait for the price to get up a lot further. But the problem with that when we're looking for dividend stocks is that the higher the price gets before we buy, the lower the dividend yield will be. So we are looking for a good solid stock with a good dividend yield, and that has begun to show some strength towards the market here. So we can see that, and we can see here a stock that actually trends in some nice channels, and when they break the channel, they usually move fast. And that has happened here. And you could take all sorts of technical analysis and pull down over this. But basically what we see here in the short term is that it is bouncing around the 20 and the 50 SMA. So for a long-term play, this could be quite a good candidate, at least from the technical point of view. Let's have a look at Stockopedia here. And what we can see is that we have a 92 in stock rank. It is a 97 in value. 58 in quality and 67 in momentum is a bit less than I normally like to see it. You know, I like it above 70, but as a famous politician said, it is what it is. When we're looking at the growth and value here, we have the PE ratio at 6.8. That is actually very good. We have the PEG ratio at 0.8, which is always also good because we're not paying too much for future growth. As you can see already here, we have a dividend yield at 5.6%. And in a second, we'll see if there's any solidity in that. As you can see, the value part here, the price to book value, price to free cash flow, EV to EBITDA, looking good. Not the best growth though. I'll get back to that in a second. Petrosky scored 6. We don't have anything here. We'll look at that in a second. As you can see, interest coverage 4.4, not the best. And these current ratio and quick ratio are often a bit problematic when we are looking at insurance and wealth management companies. So I guess that's why they're not there. When we're looking at the earnings per share normalized here, we can see that it is a little choppy, but it is going up quite nicely from left to right. We can see that their price to free cash flow, is also going up like we want to see it. And now this is a dividend stock video, so you can see the dividend yield here, just around 5%. It is growing quite nicely. Here also in 2021 they don't expect too much growth, but I think that is to consolidate a bit, because as you can see they are just above above 2, somewhere between 2 and 3 in dividend coverage here, and that means that the earnings per share can pay the dividend almost 3 times here. We can also see that the free cash flow is 10 here in trailing 12 month, but the dividend is only $1. So that means that with their free cash flow, they can easily pay the dividend. No problem there. The net debt is negative, and they have made a lot of acquisitions, but one of the reasons for the net debt is, of course, the insurance structure of the company, so that can be a bit deceiving here. All right. What does the analyst say? They say a buy. That's what we like. And when we look at the fast graph, we can see that this is basically a company that have been moving sideways for 10 years or something like that. But if we believe in it right now, or at least if you had been buying it down here, you would have been getting the good solid dividend, and that has begun to move up nicely over the last years here. But as you can see, we have some earnings and some normal PE ratio running up here. The price have gone around these lines for a while, and if we suspect it to go up towards the line again here over the next couple of years, we can actually expect a total annual return of something like 38-39%, including the dividends. So that is very nice, and it is a stable company. They're doing very well in Asia and they're expanding all over the world. So it is a stock that you can have a look at. I'll not do all the qualitative fundamental analysis here as to if you like the way they develop the markets, or if you like the management, or whatever can happen. But that's all to you. One thing I will say is that Powell, the Fed chairman, he was out yesterday saying that they would keep the interest low for a long time out in the future, and that can actually be okay for Manulife here, because that they have a lot of wealth management, and that is often a lot of focus on stock markets, and this will probably keep the stock market a bit up. On the other hand, the low interest can also be a bad thing for them, because they have a lot of insurance funds, and normally they put these in very secure investments in the bond market. But right now, with the low interest rates, they cannot really get any interest there, so they have actually been forced to go out to put some more money into these reserves to make sure that they had enough money to pay out their liabilities on the insurance part. So this interest part can be a bit of a two-edged sword here for them. So let's see how they manage it, but at least a very decent dividend and a very decent dividend coverage. All right, on to the next stock. And the next stock we should have a look at is ViacombCBS. And you know a lot of their products. And if you don't, you can see it is all the CBS channels. It is a very big cable network. They have a lot of filmed entertainment. They have some publishing. They have sports channels and news channels. If you have kids, you might know the Comedy Central and Nickelodeon. They have the Paramount, the Pluto, Showtime, all of these brands that we do know, and they are very solid and stable here. So there is a very good solid portfolio of products here. You could easily say that there are some pressure on them because they are relying a lot of their cable network, and a lot of the world's watching TV is going into streaming, but they are also following that as well. So they are changing their focus, but of course they have a lot of money tied up in the cable network, and that is where some of the analysts are a bit worrisome about their future here. But let's have a look at their charts and their fundamentals. As you can see, they have really taken a beating here. They have gone down from 70. And now in the crisis here in the spring, they went down from 43 down to 10. And that was, as I said, that's my opinion and all the analysts' opinion, that was way too cheap. And now they have been moving up. They have broken some trend lines. And as you can see, they are also doing better than the market. It is one of these stocks that I would normally not buy, since it is not in a solid uptrend. But if you're looking for good dividend and you believe in the product, and then they will come through this turnover to streaming and so on, then it can be a product or a company you should look at. If you're looking at the Stockopedia, you can see it's quite a fair stock rank here at 81. And 84 at value. And again, we have the quality and the momentum a bit below the 70, although okay high, but not 70. PE ratio at 6.3, and we can see the valuations down here are fair. The EV to EBITDA is okay. The price to free cash flow is a bit high. They do have a Petrosky score as low as 3, and an Altman C score down here at the cautious area. So this, I must admit, this is not my favorite of the 3 stock, but they're quite solid as for the dividends. So let's have a look at it. The earnings per share here has leveled a bit out, maybe gone down a bit, and that is because they've had a bit of a hard time in this competitive market. But as you can see from 21, they expect to go upwards again. When we're looking at the free cash flow, also 19 went down significantly. They are paying a dividend, and as you can see, the free cash flow here 1.42, and they are paying out only half of that in dividend, and the dividend cover is actually way higher, and that's because they are looking at the earnings per share here. They're paying around 3% in dividend. The dividend is set to grow quite dramatically here, and not as much in 21, but they are lying on a dividend cover, even with the problems they have been in here, around 4.5. So there should be quite a lot of buffer for this dividend here. As you can see, the interest coverage is not extremely high. I would like to see it a bit higher. And the current ratio is also, I do like to see that up around 2, but that it is fair enough. The net debt is high, and that is of course what rattles the investors somewhat, that they have been buying a lot now. One thing that could speak in their favor, as I mentioned earlier in the video, is that the Fed will keep the interest rate low for a very long time out in the future. So that is, of course, something that makes it a bit easier for ViacombCBS here, that they will not see a rising future on this huge debt here. So if you're looking for the dividend and the growth in dividend and good dividend cover, it could be a candidate. But as I said, it's not my number one favorite of all of these. When we're looking at the fast graph here, we can see that over a number of years, the price have been hovering around the earnings per share growth and normal PE ratio, but over the last 2-3 years, they have been really beaten down. And the question is now, because they do suspect or estimate that it will start to go up again, the earnings, and if that really can put the stock on track again, we are seeing some crazy high returns here at 53% per year. I don't think it will be that high, but when you are a dividend investor, You're not necessarily going for the high growth in the stock price. It is, of course, nice if the stock price is going up. That is a buffer on your account, but you do like to see the dividend go up and a good, nice cover for the dividend. And I think we can say that we have found that here with the ViacombCBS, and there is absolutely some potential for some upwards movements here. All right, on to the last one for today. And that is UGI. And UGI is a utility gas distributor. They distribute, they store gas, they transport it, they market it, they have a lot of energy products. So they are in the gas industry. And as you can see, it is natural gas. They are producing electricity. They have some midstream and some marketing, meaning some downstream also. They are doing a lot in the LPG, the liquid gas sector here. And yeah, that's pretty much what they do. They are working with propane and butane and LPG. And they are also moving into, or they are in the sector of heating residential areas. And just, I think it was in 2019, they added something like 14,000 new residential heatings into their portfolio. So they are working a lot on that as well. So they have the gas, they store the gas, they transport it, and now they also make money on heating people's homes. So that's pretty much what they do. Let's have a look at the charts and the fundamentals. And again, here on the technical side, we can see that this is a stock that I would not normally buy into in my momentum portfolios. It is a stock that has been in a huge downtrend. It already started last year, but of course the entire crisis here in 2020 with the virus have accelerated that drop in their price because people were all of a sudden using less gas for transportation, production, all sorts of usage for that. So they have, of course, been beaten severely down and have gone up from that. They have stabilized. They have been doing just about as well as the overall market. So that is fair enough. But again, we could have waited until it got up to 50 and showed some really good growth. But that would make the dividend yield a lot smaller. So that is what we're going for here. So many of you that knows my strategy, you would say, well, this is not really a stock for you, Hans. No, it is not really my preferred type of stock. But today it is with a focus of dividends. When we're looking at the fundamentals here, we can see that they are just around 60 to 70 here all over, quality, value and momentum. We can see the PE ratio at 12, the PEG ratio at 0.7. That's actually fairly nice here. Earnings per share growth is very good. And I should say that this might be a play for you if you think that the world, and especially United States, is on its way back on track again, where you think, yes, we are going to see some a lot more growth in the economy. People are going to use a lot more LPG gas and a lot more heating, a lot more production. If you think that, then this can be the play for you. You can see here that the EV to EBITDA is quite nice at 8. Return on capital, return on equity are nice. Petrosky score at 5. A bit down here at the cautious side. Their production side and their heating portfolio is taking on a lot of capital. So they are taking on a lot of debt to expand in these areas. So it is a debt heavy company, you could say. The earnings per share here, it took a dive in 2019, but it seems like it is back on track in 20 and 21 here. We can see that the free cash flow is quite it is quite on level here, so nothing really great in growth here. We can see that the dividend yield is around 3.7, but that it has been growing nicely, and here trailing 12 months in 2020 is showing a dividend growth of above 20% and then falling back into these around 4%, but with a dividend cover now right now in 19, where they took a bit of a beating here, it was only 1.3, but otherwise they are aiming for around 2 to 3. We can see that their free cash flow is 2.3 here and the dividend per share is only 1.3. So they are paying with free cash flow. They don't have to go out and sell stuff or take on some debt simply to pay the dividends. So that is very nice. We can see that the net debt is going up. That also shows here at the interest coverage. Again, it is quite a high leverage company, so that also means that the low interest rates for a long time out in the future will benefit this company. The analysts are saying buy, that's what we like to see. And if we're looking at the fast graph, we can see that the stock has been following this blue line, the normal PE ratio, for quite a while here, but it has been beaten down severely over the last couple of years. And if we believe that we can get back into this area up here within the next couple of years, then there might be a good earnings for us, and that is price-wise plus dividends at just below 30% per year. So where does that leave us? Yeah, well, we have the Manulife, we have the Viacom, and we have the UGI. And if you believe that everything is going to speed up now in the economy, then the last candidate here, UGI, might be the one you should go for. If you want a company that has expanded out all over the globe and are very much into the wealth management and insurance and making money there, then it is Manulife you should go with. And if you believe that ViacombCBS can turn around and focus a lot more on the streaming, and they can utilize their huge brands, as I think they might be able to, then it should be ViacomCBS you should go for. Just as you might know, that Viacom is under a lot of pressure from, for instance, of course, Netflix and HBO and so, but the new Disney, the Disney Plus and the other different Disney streaming services, they have really put a lot of pressure on Viacom, but it seems like they are starting to pick up speed, and then that one might be the one you should go for. That's all from me here now. Take care of yourself and your money out there. Remember to subscribe and like, and especially put a comment in the comment section below. You can write what you thought of this video or give me some inspiration for future videos. Bye for now.